Let me start here by saying that I would not want to own just 3 real estate investment trusts or REITs in short. If you're going to be active and build your own portfolio of individual REITs, I think that you should aim to own at least 15 to 20 REITs to properly mitigate risks. And if you're not prepared to do that, you're probably better off sticking to a passive vehicle like the Vanguard Real Estate ETF. But since so many of you keep asking me this question, here's my answer. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and if I could only own 3 REITs, it would be these. Before I get into it, quick reminder, we will hike the membership rate of High Yield Landlord on the 1st of June, so if you want to secure our currently discounted rate, I would suggest that you start your 2-week free trial right now. So the first company that I'm going to discuss here actually isn't officially structured as a REIT, but it essentially functions as if it was one. It's very similar to a hotel REIT in that it's investing in hospitality real estate. It is then operating this real estate itself to earn cash flow. But before I tell you specifically what type of assets we're talking about here, I want you to consider the company's long-term track record. The company's name is RCI Hospitality, its ticker symbol is RICK, and from 2016 till the end of 2022, the company managed to earn a roughly 8 times multiple on investors' capital, which was nearly 10 times more than the S&P 500 over this time period, even as the S&P 500 was also very rewarding. I'm using this time frame specifically because the company changed its capital allocation policy in 2016 and essentially became a new company, and I'm ending it at the end of 2022 because that's really when the bear market began for the REIT sector. So what was the company's secret to generating these incredibly high returns? Put it simply, REIT is focusing on a highly fragmented sector with a lot of sellers but very few buyers, and this is allowing REIT to buy very attractive assets at very low multiples, which then result in a very significant spread over its cost of capital, expanding its free cash flow on a per share basis at a very rapid rate. And the sector that we're talking about here are that of adult nightclubs, also known as strip clubs or even gentlemen clubs. There are very few buyers in this space because of the social stigma of owning one of these assets. Also, the difficulty is to access capital because banks won't lend you money to acquire a strip club. And also the specialized skill set that's required to manage one of these clubs. Some of you may think that it's probably quite similar to managing a bar or a restaurant, but it really isn't, because you need to be able to sniff out things like prostitution, drug dealing, racketeering. If you're not able to catch on these things early, you can very quickly get in trouble. Most investors, business owners, successful, wealthy people rather avoid all these issues, and so they simply avoid this sector and they are not acquiring these assets. Despite them being quite attractive, they generate a ton of cash flow and they're essentially local monopolies in their markets because you need to get a license, and these licenses are almost impossible to get these days. And so despite there being no buyers, there are actually a lot of sellers for these clubs because most club owners today are approaching retirement age, and this is not exactly the type of assets that you pass on as a legacy to your next generation. And so a lot of sellers but very few buyers. This is resulting in very low valuations for these clubs, and this is a great opportunity for REIT that's able to buy these high cash flowing local monopolies in a way at just 3 to 5 times cash flow, resulting in a massive spread over its cost of capital. Typically, REITs are happy if they're able to earn 100 to 200 basis point spread over the cost of capital. Just recently, I filmed a video on realty income in which I explained that it was very good news that it was able to earn 120 basis point spread on its new investment in the last quarter. However, REIT is earning closer to 10 to 20 times as much on its new investments because its cost of capital is roughly 10%, but it's acquiring clubs at a 25 to 33% cash flow yield. So the spreads are massive here, and this has allowed REIT to grow its cash flow by over 20% annually ever since it changed its capital allocation policy. And I think that the company has a very long runway of rapid growth prospects because today it's still relatively small, owning only roughly 50 clubs. And it has an acquisition pipeline of potentially up to 500 clubs in the US, maybe even more internationally. So I think that it can keep replicating the same model for a long time to come. It has also significant competitive advantage in that it's actually the only company in this space with access to public capital. There are just a few other players and none of them are publicly listed like REIT, and they also don't have the same track record of acquisitions, and so this is a major competitive advantage for REIT. However, the company is going through a setback right now and it has caused its share price to crash. So there are two setbacks here. Firstly, the same property performance of its clubs is suffering at the moment. It's negative, but there's actually a good explanation for this. And simply that 2021 and 2022 were exceptionally strong years because there was a lot of free stimulus money going around. There was also a lot of deferred spending on experiences following the pandemic, and international borders were still mostly closed. So people were mostly traveling domestically. And so this caused the clubs of REIT to perform exceptionally well. A good example is Tootsie's, which is the biggest adult nightclub in the world. It's in Miami. It's owned by Rick. I visited it really for the purpose of due diligence, believe it or not, about a year ago. And the regional manager there explained to me, I don't remember the numbers from the top of my head, but their cash flow had bumped very significantly during those 2 years. But that obviously then wasn't sustainable as international borders reopened, the free stimulus money ran out, and people were tired of spending so much on experiences in the post-COVID world. Then we saw comps come down and suffer. The cash flow came down a bit closer to where they were prior to the pandemic. And so that's leading to negative comps at the moment. It hurts the market sentiment of the stock. Then the second setback is that we now haven't had new club acquisitions in a little while. And this is a big deal because the number one reason behind REIT's exceptional growth has been its ability to acquire new clubs at a large spread over its cost of capital. But we now haven't had anything major for about 1 year. But again, there's a good explanation for this. The management of REIT is telling us that they could acquire new clubs if they wanted, but they would be overpaying because the club sellers are basing the valuations of their clubs on the numbers of 2021, 2022. But we now know that these numbers were not sustainable, so the management of REIT prefers to wait a bit so that club owners come to this realization as well that this performance wasn't sustainable, it was exceptionally good. And so, to be honest, I would have hoped that they would have returned to acquisitions already by now. It's taken a bit longer than I would have wished for, but I'm quite confident that they will return to acquiring new clubs later this year as club owners come to this realization and start pricing their clubs based on the 2023 and 2024 performance. Even then, because most investors only care about the short term, they've now priced the stock very cheaply. It has crashed from nearly $100 closer to $50. If you use the free cash flow from last year, it's priced at something like 7 to 8 times its free cash flow. I think that this free cash flow is going to grow very significantly over the long run. As I mentioned, it's been growing by roughly 20% per year. And on a per share basis, since they changed their capital allocation policy, this growth obviously is bumpy. It's not 20% each year, but over the long run, I think it's going to keep on growing rapidly, and therefore I think that this is a very good opportunity to add very significant alpha to your portfolio. Hey, before I go into the next company, can you please do me a huge favor and click the like button? That helps me a lot to grow this channel. Thanks so much in advance. Then if I could only own 3 REITs, I would want one of them to own residential properties. And today, arguably the best deal is BSR REIT, ticker symbol HOM.U in Canada, and BSRTF in the US. This is arguably the cheapest apartment REIT today, and it's also one of the likeliest buyout targets in my opinion. There are 4 things that make BSR uniquely attractive today. For one, it specializes on rapidly growing Texan markets like Dallas, Austin, and Houston, and these markets are expected to be some of the best performing over the next decade or 2 as they enjoy rapid population growth, rapid job growth, and their rent-to-income ratios are also far lower today than in popular coastal markets, and as they close the gap, we could see significant rent growth over the coming decade. Secondly, BSR owns mostly Class B properties that are affordable with an average rent of right around $1,500 per month, and so they are well protected from the new supply, which is mostly hurting the Class A properties that are much more expensive than those of BSR. And so despite facing some oversupply in these markets in 2024, BSR has still guided to grow its same property NOI by 2% this year. It has also noted that they expect 2025, 2026 and 2027 to be far stronger years because new construction starts have now dropped to the lowest level since the great financial crisis. Thirdly, the company stock is very heavily discounted, trading at a roughly 35% discount to the net asset value, a high 6% cap rate, which is also far higher than what you will be getting in the private market today if you try to buy comparable assets. So this is an exceptionally low valuation for Texan apartment communities. I think that there are two main reasons for this low valuation. None of them really have much to do with the fundamentals of the company. Firstly, this is a small cap. Small cap REITs are today priced at large discounts relative to their larger peers. And the second reason is even more interesting. It's that BSR is primarily listed in Canada despite owning most of its properties in the US. And I think that they made this decision of listing in Canada when they went public, mainly because it was far cheaper and easier, and the expenses are important for a small company like BSR. But it appears to be resulting in a lower valuation because Canadian investors simply don't know about the growth story that's happening in Texas as much as well as American investors. And then the fourth interesting thing about BSR is that the management is one of the biggest shareholders. They own about 40% of the equity. They've been buying back stock very aggressively, and they've been also significant insider purchases over the past years. In the fourth quarter alone, they bought over 30 million worth of shares, which is very significant for a company that has a 600 million market cap. And so this significant skin in the game and their behavior of buybacks and insider purchases leads me to think that this is a likely buyout target. Eventually, if they cannot get the public market to recognize the fair value of their properties, I would expect them to simply liquidate the portfolio, sell it to a bigger player like Blackstone. Perhaps not Blackstone because this is a bit too small for them, but another private equity player similar to them, or they might simply privatize the company because at the end of the day, there are a lot of expenses and a lot of headaches in running a public company. And if you're not able to get the public market to agree with your stock and give it the right valuation to raise additional capital, then there is really no benefit in being public. So in short, the pitch here is that you get to buy an interest in a diversified portfolio of Texan apartment communities at 60 cents on the dollar, and you get the added benefits of professional management, economies of scale, a limited liability, lower cost financing that you probably couldn't get yourself, many other advantages. And so in my opinion, the risk reward is very attractive here. If you were offered that in the private market, you would probably jump on the opportunity, but somehow because this is a publicly listed company, a lot of investors aren't showing any interest. I think that eventually the stock will reprice at closer to its net asset value. This could unlock about 50% upside from here. While you wait, you also earn a monthly 5% dividend yield, and the company is still retaining nearly half of its cash flow to buy back shares and create additional value for you. And then if I could only own 3 REITs, one of them would be Big Yellow Group, ticker symbol BYG. Thanks, by the way, for the people in the comment section telling me that it's Y, not Ypsilon. I'm learning. English is a foreign language for me. I appreciate it. I've covered Big Yellow quite a few times on this channel, so I hope this doesn't get repetitive for you, but I'll try to cover it from a slightly different angle here. The thesis is very simple here, and I can really recap it in 3 main points. The first point is that self-storage has been by far the most rewarding property sector in the US over the past 3 decades, earning nearly 20% average annual total returns. But the American market has now become oversupplied, and therefore future returns are likely to be significantly lower. But the European self-storage market is still 20 years behind. Big Yellow Group is the leader in the UK, and it's now replicating the same successful model in the US, earning very significant spreads over its cost of capital as it develops new properties, and this is leading to very rapid growth and strong total returns. The second point is that the company has very low debt with a 15% loan to value. You know, when you buy your home, you typically use a loan to value of 80 to 90% and you consider that safe, while Big Yellow is today at 15%, which means that it could very significantly expand its leverage if it desired to develop new properties. It has quite a few projects on the way today with expected initial yields of 9%, so that's a very big spread over its interest rates that it could get on additional debt to expand its FFO per share. And then the third point is that this REIT has an exceptional track record, having managed to grow its FFO per share by roughly 11% annually over the past 20 years. It has managed to earn about 15% average annual total returns to its shareholders, and that's despite suffering a major setback during the great financial crisis because it was over-leveraged. If you adjust for that, the annual total returns would have been closer to 20%, and I think that it can keep this going for another decade or two. Even then, the share price of the company has crashed along with its American peers like Public Storage, Extra Space Storage, which are suffering from oversupply. But again, there is no oversupply in the UK. There's actually 10 times less storage space per capita in the UK than in the US. And so I don't think that this crash is justified in this case. The company is today priced at 16 times FFO, a roughly 25% discount to its net asset value. That may not seem that low to you, but keep in mind that this is a REIT with a very low leverage, leverage and very rapid growth prospects. It's also priced today at a near 5% dividend yield, which is a historically high level for Big Yellow Group. And if you now expect its historic growth to continue, you add simply the 5% dividend yield with 10% of annual FFO per share growth, you get to 15%. Add to that a bit of multiple expansion, you can easily get to 20% going forward. And this is why Big Yellow would be one of my choices for these 3 REITs. Once more, if you want to access my entire real money REIT portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter. We're offering a 2-week free trial. I'll put a link to it in the description of this video. We will hike our membership rate on the 1st of June, so I would recommend that you start your free trial prior to that to at least lock this discounted rate. If you then don't like it, you can simply cancel. You won't be charged anything in the first 14 days. Finally, if you enjoyed this content, I would really appreciate it if you could show your support by clicking the like button, subscribing to the channel, and also finally let me know in the comment section what other REIT you would like me to cover next. I take your suggestions into account and I'll make sure to provide you more value over the coming weeks. Thank you so much in advance. See you at my next one. Bye bye.